Russia just pulled the plug on Europe's energy lifeline, sending shockwaves across the globe. Even China didn't see this coming. For decades, Europe has relied heavily on Russian oil to keep its economy running. But now, in a move that stunned even global superpowers, Russia has abruptly cut off its oil exports to the European Union. This decision could plunge Europe into an energy crisis unlike anything seen in modern history. Now, the question on everyone's mind is, what does this mean for global oil prices? Will Europe be able to survive without Russian energy? And is this the end of Putin's energy empire, or the start of a new Cold War? We're about to break down the full impact of Russia's bold move and reveal what it means for the future of global energy. Keep watching. You won't want to miss this. To understand why Russia's decision to cut oil exports to the European Union is such a big deal, we need to look back at how Europe became so dependent on Russian energy in the first place. This relationship didn't happen overnight. It was the result of decades of strategic planning, infrastructure investments, and long-term contracts that cemented Russia's dominance over Europe's energy supply. Before the geopolitical tensions escalated in 2022, Europe was profoundly reliant on Russian energy. Nearly 40% of the EU's natural gas consumption came from Russia. This dependency was particularly heavy in countries like Germany and Italy, where Russian gas wasn't just a convenience, it was a lifeline. Whether it was heating homes during bitterly cold winters or powering industries that formed the backbone of the European economy, Russian gas was indispensable. When it came to oil, the numbers were equally staggering. Around a quarter of all the oil consumed in the EU came directly from Russia. This wasn't just a casual trading relationship, it was a fundamental pillar of Europe's energy strategy. Part of what made this relationship so durable was the infrastructure built to maintain it. The Nord Stream 1 pipeline, operational since 2011, connected Russia directly to Germany through the Baltic Sea. Bypassing traditional transit countries like Ukraine, it ensured a steady, uninterrupted flow of gas to Europe's largest economy. Plans for Nord Stream 2 aim to double this capacity, further intertwining European energy needs with Russian supplies. Gazprom, Russia's state-controlled energy giant, solidified this dependence through long-term contracts with European nations. These agreements didn't just guarantee consistent delivery. They also included binding agreements that made it economically impractical for European countries to diversify their energy sources. Breaking away from Russian energy wasn't just politically challenging, it was financially difficult too. When the geopolitical crisis erupted, Europe was caught in a tricky position. Desperate to reduce its dependency on Russian energy, the EU imposed sanctions targeting the Russian energy sector. However, these measures fell far short of achieving their intended goal. Instead of a complete embargo, the EU implemented partial bans, allowing for crucial exemptions to minimize economic fallout. These half measures opened the door for Russia to exploit loopholes that kept the energy flowing. One of the most significant loopholes involved liquefied natural gas, LNG. Despite the sanctions, LNG imports from Russia to Europe surged by 20% after 2022. Unlike pipeline gas, LNG shipments often slipped through the cracks of regulatory restrictions, allowing Russian gas to continue entering European markets under a different guise. Russia's ability to maneuver around sanctions didn't stop there. Faced with shrinking direct exports to Europe, Russia turned to shadow fleets and third-party buyers, a large network of older, poorly regulated tankers, often registered under flags of convenience, kept Russian oil moving. Countries like India and Turkey became key intermediaries. These nations would buy Russian crude, refine it, and then export the petroleum products to other markets, including Europe. Through this elaborate network of middlemen, Russian energy maintained a foothold in Europe despite the political and economic barriers erected to block it. Russia's strategic play didn't start with the invasion of Ukraine, though. Gazprom had been manipulating gas storage levels as early as 2021, deliberately lowering supplies to European facilities to create uncertainty and drive up prices. This wasn't just a business move, it was a calculated effort to remind Europe of its vulnerability. By the time Russia rerouted much of its oil and gas supply to Asia after the invasion of Ukraine, it still managed to retain significant influence over the European market. The Kremlin didn't just abandon its hold, it diversified and adapted. Europe's struggle to break free from Russian energy shows just how deep this relationship had become. Despite ambitious plans to wean itself off Russian supplies, the continent found itself caught in a web of strategic dependency that had been years in the making. And now, with Russia officially cutting oil exports, the impact of that dependency is about to hit harder than ever. The question remains, how will Europe survive without its most reliable energy source? Because, like it or not, Europe's dependency on Russian energy can't just vanish overnight. But now, with Russia making the bold move to cut oil exports to the EU, the continent is staring down the barrel of an unprecedented crisis. The safety net that Europe had desperately tried to weave over the past few years is coming undone, and the immediate consequences are starting to hit hard. The breaking point came when Russia, squeezed by its own challenges, drastically cut oil exports. Sanctions on Russian tankers and recent drone attacks on key refineries forced Moscow's hand, pushing oil output down to just 9 million barrels per day. This was a huge adjustment. The once bustling Baltic Sea exports saw a staggering 17% drop in early 2025, with the Ust-Luga port, one of Russia's most crucial oil terminals, operating at half its usual capacity. These cuts weren't just numbers on a spreadsheet. They were a direct blow to Europe's energy security. What's worse, this didn't happen in a vacuum. The attacks on Russian refineries, many suspected to be orchestrated by Ukraine or its allies, crippled production capacity and added to the chaos. Russia, already facing economic pressure from Western sanctions, found itself backed into a corner. Cutting oil exports wasn't just a retaliation, it was a necessity. For Europe, the timing couldn't be worse. One of the most obvious vulnerabilities exposed by these cuts is Europe's continued financial support of Russia, even amid the Ukrainian conflict. Since 2022, the EU has paid Russia an astounding 196 billion euros for energy, money that has undoubtedly fueled Russia's military ambitions. In a bitter twist, it's become clear that Europe has been funding the very machine it's trying to defeat. To put it into perspective, in just the third year of the war, EU member states spent 21.9 billion euros on Russian oil and gas, significantly more than the 18.7 billion euros allocated to Ukraine in financial aid during 2024. Even US President Donald Trump bluntly criticized Europe's spending priorities, telling Congress that the EU has funneled more money into Russian fossil fuels than into defending Ukraine, by far. Now, with oil exports cut, Europe is paying the price for that prolonged dependency. Shipping costs are surging as tankers become scarce. The few vessels willing to transport Russian oil are demanding astronomical fees, given the risks associated with potential sanctions or attacks. Meanwhile, energy companies across Europe are scrambling to find alternative suppliers, but that's proving easier said than done. The infrastructure needed to replace Russian crude simply isn't there. Building new pipelines, expanding LNG terminals, or securing long-term contracts with the Middle East would take years. Time Europe doesn't have as the economic fallout unfolds in real time. It's not just about keeping cars on the road or factories running. The real fear is in the social and political upheaval that an energy crisis could trigger. Inflation, already problematic in many EU countries, could spiral out of control as fuel costs seep into every corner of the economy. The EU's leaders find themselves caught between a rock and a hard place. Cutting off Russian energy was supposed to be a step toward crippling the Kremlin's war machine, but the reality is more complicated. Now, Europe faces the difficult task of finding energy alternatives while grappling with the socio-economic consequences of years spent entangled with Russian oil and gas. As the crisis deepens, one question looms large. Can Europe withstand the shock, or will the continent fracture under the pressure of its own dependency? The next few months will be crucial as the EU scrambles to stabilize its energy supplies and prepare for an uncertain future. The world is watching, and so is Russia, calculating its next move while Europe teeters on the brink. Europe's response to Russia's oil export cuts has been frantic and divided, as member states struggle to find a unified strategy to secure energy independence. The pressure is immense. For years, Russia's vast reserves acted as Europe's energy backbone, and cutting that cord has left the continent grasping for alternatives. The most immediate move has been to secure new suppliers, but it hasn't been easy or cheap. The United States has stepped in with liquefied natural gas, LNG exports, but that switch came at a significant cost. Unlike the relatively inexpensive pipeline gas from Russia, US LNG requires complex and costly infrastructure, including terminals that many European countries lack or have had to rapidly expand. Middle Eastern oil has also started to flow into Europe, but it's not without its own set of challenges. Transporting crude from the Gulf to European refineries is far more complicated and expensive than moving it through Russia's extensive pipeline network. Shipping routes are longer and riskier, particularly with geopolitical tensions simmering in the Strait of Hormuz. Insurance costs for tankers have skyrocketed, adding yet another layer of financial strain. Despite these challenges, Europe has made some notable progress in diversifying its oil sources. Germany's Schwedt refinery, historically dependent on Russian crude, has successfully switched to non-Russian oil delivered via Poland. This shift was politically and logistically complex, requiring new agreements and infrastructure adjustments to accommodate the change. But it's far from a comprehensive solution. Meanwhile, Europe's green energy transition has taken a hit. The initial hope was that cutting ties with Russian fossil fuels would accelerate the adoption of renewables, and to some extent, it has. Investment in solar and wind projects surged after 2022, driven by both policy incentives and the urgent need to reduce reliance on hostile states. Yet, the reality on the ground tells a more complicated story. Despite the push for cleaner energy, many countries have backslid into old habits, especially Germany, which found itself reviving coal-fired power plants to meet energy demands. What's more, political maneuvering has further complicated the transition. In a controversial move, some EU states proposed labeling Russian gas as Azeri to sidestep sanctions, exploiting complex supply chain loopholes to maintain access while avoiding the political fallout. Critics have slammed this as blatant hypocrisy, accusing the EU of undermining its own sanctions while pretending to take the moral high ground. It's a stark reminder of how economic pressures can erode even the most principled stances. The question is no longer just whether Europe can survive without Russian oil, but also how the rest of the world is reacting to Russia's new play. The truth is that the global ramifications of Russia's oil export cuts are sending shockwaves far beyond Europe, with China being one of the most alarmed. For years, China relied heavily on discounted Russian oil to fuel its booming economy, a strategic partnership that became even more crucial after the West imposed sweeping sanctions on Moscow. But now, with Russia tightening its oil exports and logistical challenges piling up, Beijing finds itself caught in a dilemma that could significantly alter its energy strategy and economic outlook. One of the biggest problems China faces is the disruption of its shadow tanker fleet, a network of aging, unregistered vessels that have quietly transported Russian oil under the radar of Western sanctions. These so-called shadow fleets became essential after formal maritime routes became politically and legally risky. However, recent international crackdowns on these operations, combined with escalating shipping costs, have put a severe strain on China's ability to maintain its energy imports. The costs associated with transporting oil have surged, primarily due to the geopolitical risks and heightened insurance premiums. An Aframax tanker, capable of carrying around 700,000 barrels of crude, now costs as much as $6.5 million per voyage, nearly triple the pre-war rates. This sudden spike in transportation costs has forced Chinese importers to recalculate the economic viability of their Russian oil deals. What was once a bargain is now teetering on the edge of impracticality, especially when cheaper and more secure alternatives are becoming increasingly attractive. The economic implications extend far beyond China. Oil price volatility remains a persistent threat to global markets. During the early months of the Russia-Ukraine war, Brent crude prices surged by a staggering 56%, reflecting the sudden instability in supply chains and the fear of prolonged conflict. Although prices later stabilized, the underlying volatility has never fully dissipated. Now, with Russia cutting exports even further, traders and analysts are once again bracing for a potential surge in global oil prices. This instability doesn't just threaten oil-importing nations, it carries the risk of a global recession. Rising fuel costs ripple through every sector, increasing the cost of manufacturing, transportation, and even basic consumer goods. Inflation rates, already at multi-decade highs in many countries, could skyrocket if oil prices are pushed even higher. The International Energy Agency has warned that another oil shock of this magnitude could plunge the global economy into recession, dragging down both developed and developing nations alike. Geopolitically, the situation is shifting power balances in unexpected ways. One notable beneficiary is Turkey, which has found itself strategically positioned as an energy middleman between Russia, Europe, and Asia. By facilitating the transfer of Russian crude to secondary markets, Turkey has gained newfound leverage, both politically and economically. President Recep Tayyip Erdogan has exploited this role to strengthen Turkey's regional influence while also securing favorable energy deals for his own country. Meanwhile, the United States and the European Union have been quick to capitalize on the chaos, signing significant LNG agreements that are reshaping the transatlantic energy landscape. Under President Trump's assertive energy policies, the U.S. has doubled down on LNG exports to Europe, reinforcing ties that were strained during previous administrations. China, on the other hand, is facing a strategic conundrum. Its energy security is being tested, and while it has turned to Middle Eastern suppliers and even increased its domestic coal production, the loss of cheap Russian oil has left a noticeable gap. With global prices climbing and logistical issues multiplying, Beijing's economic planners are scrambling to stabilize their energy reserves without succumbing to Western pressure. The broader consequences are profound. If China scales back its economic support for Russia or pivots away from Russian oil altogether, it could drastically reduce Moscow's revenue streams, potentially forcing the Kremlin to reconsider its hardline stance. At the same time, any sign of China distancing itself from Russia would send shockwaves through the geopolitical landscape, possibly altering alliances and recalibrating the global balance of power. In a world where energy security increasingly dictates foreign policy, Russia's decision to cut oil exports has set off a cascade of unintended consequences. Countries around the globe are now reassessing their alliances, energy strategies, and economic priorities. Whether this marks the beginning of a new era of energy realignment or merely a temporary disruption remains to be seen. But one thing is clear: the aftershocks of Russia's bold move are just beginning to be felt, and no nation can afford to ignore the consequences.